You walk into Costco assuming the products are the business, $270 billion in merchandise sales. Yet the real profit engine is something you already paid for before you picked up a single item. Everything around you seems to confirm the assumption. Pallets of groceries, stacked televisions, furniture, paper towels by the hundred. It looks like a store built to sell enormous amounts of merchandise. The business looks simple. Costco buys products, adds a margin, and sells them to you for more. That is how most retailers make money. The larger the gap between cost and price, the more profit they keep. But when you look beneath Costco's prices, something does not fit. In fiscal 2025, Costco generated nearly $270 billion in merchandise sales. Its merchandise gross margin was only about 11.1%. $270 billion sounds enormous. But sales are not profit. First, the merchandise must be paid for. Then employees, warehouses, transport, technology, and the rest of the business. The number that enters the register is not the number the company keeps. Costco's 2025 numbers show the structure clearly. Merchandise produced roughly $30 billion in gross margin. Selling, general and administrative expenses consumed most of that. Then, beside the merchandise business, another stream contributed more than $5.3 billion. Membership fees. Before you can regularly shop inside, you must first pay for access. The card in your hand looks like an entry pass. Financially, it is something more important: recurring revenue collected before you purchase a single product. One membership fee is not remarkable, but Costco had approximately 81 million paid members at the end of fiscal 2025. Together, they produced more than $5.3 billion in annual membership revenue. Merchandise revenue rises and falls with what people buy. Membership revenue is different. It arrives on a recurring cycle. It is easier to anticipate, and it does not require Costco to sell another television or package of groceries at the moment the fee is collected. But recurring revenue only remains valuable if members keep paying. That creates Costco's most important question. Not simply, how much profit can we make from this product? But will this price make the membership feel worth renewing? In the United States and Canada, Costco reported a membership renewal rate of 92.3%. Worldwide, it was 89.8%. Most members choose to pay again. The membership changes the incentive. A traditional retailer may try to extract more from each purchase. Costco also needs merchandise profit, but it has another reason to resist pushing prices too high. Higher margins could make today's transaction more profitable while making next year's membership less valuable. This is the decision beneath the business. Costco can pursue more profit from each item, or it can protect the price advantage that gives customers a reason to pay for access. The company deliberately operates at lower gross margins than many other major retailers. Membership fees alone do not make low prices possible. Costco also designed its operations to function efficiently on thinner margins. Fewer products, enormous purchasing volume, fast inventory movement, and warehouses that remove many of the costs customers expect from traditional retail. A conventional supermarket may offer many brands and sizes in a single category. Costco carries fewer than 4,000 active stock-keeping units. Fewer products concentrate demand. That concentration creates purchasing power. A supplier that earns a place inside Costco gains access to enormous volume. Costco, in return, can negotiate around scale and price. Even the building reflects the same logic. Products stay on pallets. Extra inventory sits above the sales floor. Decorations are limited. Handling is reduced. Warehouse hours are generally shorter than those of many conventional retailers. What looks basic is also less expensive to operate. Costco also depends on rapid inventory turnover. Products move through the system quickly. In some cases, merchandise can be sold before payment to the supplier becomes due. That means less cash remains trapped in inventory for long periods. Now the full mechanism becomes visible. Low merchandise margins help Costco keep prices attractive. Attractive prices make the membership feel valuable. Valuable memberships renew. Renewals create recurring revenue and a large, stable member base. That scale strengthens purchasing power and operating efficiency, which helps maintain low prices again. Costco reinforces the relationship through its executive membership. Executive members pay an additional annual fee and receive a reward on qualifying purchases. In fiscal 2025, executive members represented fewer than half of paid memberships, but generated approximately 73.6% of worldwide sales. From the aisle, you see products. Costco sees something larger: a member relationship, a renewal decision, a recurring revenue stream, and a system in which low product margins can strengthen the value of everything surrounding them. This does not mean Costco loses money on all its merchandise, and it does not mean every dollar of membership revenue becomes pure profit. Costco remains a retailer, and merchandise remains essential to its earnings. But the membership system allows the company to operate differently from a retailer that depends only on maximizing each transaction. When you entered, the products looked like the business. Now you can see the incentive underneath them. Costco does not need to extract the highest possible profit from every item in your cart. It needs the prices in that cart to convince you that the card in your hand is worth paying for again. The products make the membership valuable, and the membership makes low product margins possible. Now you know where to look.